You probably think your biggest problem in trading is finding the right strategy. It isn't. The strategy is usually not the part that destroys the trader. It is what happens after the strategy gives you an opportunity, because you can have a good setup and still lose money. You can have a bad setup and still make money. You can make $5 on a trade you had no business taking, and you can lose $50 on a trade that was actually well planned. That is where trading becomes difficult. The market does not reward you immediately for making good decisions, and it does not punish you immediately for making bad ones. Sometimes you do everything right and lose. Sometimes you do everything wrong and win, and that creates a dangerous illusion. You start believing that the outcome of the trade tells you whether the decision was good. It doesn't. A winning trade can hide a terrible decision. A losing trade can come from an excellent one. The trader who survives long enough to become consistently good eventually understands this. Trading is not really about knowing what happens next. It is about knowing what you will do when you do not know what happens next. And that changes everything. There are rules you can write on paper, but the rules that truly matter are the ones you follow when your heart is racing, when your last trade just lost, when price is moving without you, and when you are tempted to break your own plan because you suddenly believe this trade is different. So if you want to become a better trader, you have to stop asking only one question: how do I find better trades? You also have to ask, how do I become the kind of person who can handle good trades, bad trades, winning days, losing days, and uncertainty without destroying my own account? That is where the real work begins. Your first rule is simple: protect your capital before you think about making money. It sounds obvious. Almost everyone agrees with it. But watch what happens when a trader loses. They lose $50. Then they think, I need to make that 50 back. So they take another trade. Then that trade loses. Now they are down 100. The emotional pressure increases. They increase their position size. They tell themselves they only need one good trade. And suddenly, the original $50 loss is turned into a much bigger problem. The market did not destroy the account. The reaction to the loss did. This is why protecting capital is not just a money management rule. It is a psychological rule. When your risk is small enough, you can think. When your risk is too large, you start negotiating with the market. You move your stop. You close trades too early. You stare at every candle. You begin imagining what the market should do. You stop reading price and start reacting to your emotions. A small loss can be information. A large loss can become an emotional event. Your job is to keep losses small enough that you remain mentally available for the next opportunity. The second rule is this: never risk money you emotionally need back. Imagine losing an amount that makes you uncomfortable, not because the amount is objectively huge, but because you desperately wanted that money to remain in your account. Now imagine the next setup appearing. Can you take it calmly? Probably not. Part of you will be thinking about the previous loss. You will want this trade to fix the last trade. That is dangerous. The moment one trade becomes responsible for repairing your emotional state, you are no longer trading that setup. You are trading your need for relief, and the market does not care about your need for relief. Trade only with an amount you can genuinely accept losing. Not happily, not casually, but honestly. You should be able to say, if this trade loses, I will still follow my plan tomorrow. That sentence is more powerful than many complicated trading techniques. The third rule is never confuse movement with opportunity. The market moves all day. That does not mean you should trade all day. Sometimes price moves quickly and traders feel an immediate need to participate. A large candle appears, the market breaks a recent high, price suddenly starts running, and the trader thinks, I am missing it. That feeling is powerful. It can make you enter after the opportunity has already passed. Imagine watching a bus leave a station. You missed it. Would you run behind the bus and jump onto it while it is moving? Probably not, but traders do exactly this in the market. They watch price move without them and chase it because they cannot accept being late. Sometimes the best trade is the one you did not take. Let the market go. There will be another opportunity. You do not get paid for participating in every movement. You get paid for managing risk when the conditions make sense. The fourth rule is do not enter a trade simply because you are bored. This sounds almost ridiculous, but boredom is one of the quietest causes of overtrading. You sit in front of the chart, nothing is happening. 5 minutes pass, 10 minutes, 30 minutes. You feel like you should be doing something. So you start looking for reasons to trade. Suddenly, a small movement becomes a setup. A level that you would normally ignore starts looking interesting. You enter, not because the market gave you a great opportunity, because you wanted something to happen. This is the same reason people keep checking their phones when there is nothing new. They are uncomfortable with stillness, but trading requires stillness. A professional fisherman does not throw his net into the water every 30 seconds because he feels unproductive. He waits, he watches, he understands that empty time is part of the process. Your ability to sit out of the market is a trading skill. The fifth rule is have a reason before you enter, not a story. A reason. There is a difference. A story sounds like this. Price looks like it wants to go up. A reason sounds like price has reached an area I plan to watch. It has shown me the behavior I was waiting for. My entry is here. My stop is here. And if I am wrong, I lose this amount. The first is emotion. The second is a decision. Before you enter, you should know what you are waiting for. You should know what would make the trade invalid. You should know where you are wrong, and you should know how much you are willing to lose. If you cannot answer those questions, you probably do not have a trade. You have a feeling, and feelings are not a trading plan. The sixth rule is never move your stop loss simply because you do not want to be wrong. This is one of the hardest lessons in trading. You enter, price moves against you. Your stop is getting closer. You start thinking, maybe I should give it more room. So you move the stop, price moves further. You move it again. Now the original risk no longer exists. You are not managing a trade anymore. You are trying to prevent a loss from becoming real. But the loss was already real when your original plan was invalidated. Moving the stop does not change reality. It only changes the amount you are willing to lose. Ask yourself something uncomfortable. Am I giving the trade more room because my analysis changed or because I cannot accept being wrong? That question can save you from a lot of damage. The seventh rule is accept that being wrong is part of being a trader. You do not need to predict every move. You do not even need to be right most of the time in every style of trading. You need a process that can survive uncertainty. Think about a weather forecast. A forecast can say there is a high chance of rain. You prepare for rain, then the sun comes out. Was the preparation stupid? No. The forecast was a probability. Trading is similar. You can have a strong reason for expecting price to move in one direction and still be wrong. That does not mean your intelligence disappeared. It means the market produced a different outcome. Your job is not to eliminate uncertainty. Your job is to build a process that survives it. The eighth rule is do not let one loss become two losses. And I do not mean physically. I mean emotionally. You take a trade, it loses, the trade is finished. But then you become angry. You immediately enter another trade. That trade is not really the second trade. It is the first loss continuing through your behavior. This is revenge trading. You are not trading because the market gave you a good opportunity. You are trading because you want the previous result to disappear. The market becomes your opponent. You want to beat it. But the market is not your opponent. There is nothing to defeat. There is only price moving through an uncertain environment. If you lose, step away, breathe, review the decision, ask whether you followed your plan. If you did, accept the loss. If you did not identify the mistake, either way, the lesson is more valuable than revenge. The ninth rule is do not increase your position size because you are trying to recover. This is one of the fastest ways to turn a normal losing day into a disaster. You lose, then you double your size. You tell yourself, if this one wins, I will be back where I started. That sounds logical when you are emotional. It is not. You are allowing the previous outcome to determine the risk of the next decision. Imagine a gambler losing money at a casino and doubling every bet because he believes the next one must recover everything. That is not a strategy. It is emotional arithmetic. Your next trade should be based on your next setup, not your previous loss. The 10th rule is Do not take profit simply because you are afraid of giving it back. This is the other side of the problem. Some traders cut losses too slowly and winners too quickly. Price finally moves in their favor. They see a small profit, suddenly fear appears. What if it comes back? So they close. Price continues moving. They watch it travel exactly where they expected. Now frustration appears. They tell themselves, I knew it. But knowing is not enough. If your plan says you should hold the trade until a certain condition changes, then you need to give the trade room to reach that point. You cannot demand that every winning trade make you feel comfortable. Sometimes being in a profitable trade feels uncomfortable. That is normal. The goal is not to feel good. The goal is to execute well. The 11th rule is stop trying to make every trade exciting. This may be one of the strangest lessons you will ever learn. A beginner often wants trading to feel exciting. They want big moves, big profits, large positions, constant action. But excitement and consistency rarely live together. The more exciting trading becomes, the more likely emotion is influencing your decisions. Professional thinking often looks boring. Small risk, waiting, watching, doing nothing, taking one trade, closing the platform, coming back tomorrow. There is no dramatic story, and that is exactly the point. Your trading account does not care whether your day was exciting. It cares whether your decisions were sustainable. The 12th rule is trade what is in front of you, not what you hope will happen. Hope is dangerous when it enters a trade. Imagine price approaches a level you have been watching. You enter. Then price begins moving against you. Instead of accepting that the setup may be failing, you begin searching for reasons to remain in the position. Maybe it will come back. Maybe the next candle will reverse. Maybe buyers are still there. You are no longer reading the market. You are defending your position. There is a subtle difference. A trader asks, what is price showing me? An emotional trader asks, how can I prove that my trade is still right? Those are completely different questions. One seeks information. The other seeks confirmation. The market owes you neither. The 13th rule is learn to recognize obvious areas where traders are likely to place their stops. You do not need complicated language to understand this. Think about where people naturally put protection above a clear recent high, below a clear recent low, around obvious support, around obvious resistance. These areas can contain many orders. Sometimes price moves into those areas, triggers those stops, and then reverses. Other times price breaks through and continues. The important lesson is not that every stop will be taken. It is that obvious levels can become important because many traders are watching the same place. So instead of blindly entering because price reached a high or low, ask who might be trapped here? Who might be forced to exit if price moves slightly further? Is price simply breaking the level, or is it showing me something different after reaching it? You are not trying to predict perfectly. You are learning to observe the behavior around important areas. The 14th rule is wait for evidence. This does not mean waiting until the trade is obvious to everyone. It means giving the market a chance to show you whether your idea is behaving as expected. Imagine you believe price will reverse from a certain area. You enter the moment it touches the level. Maybe it works, maybe it does not. But what if you waited? What if price moved slightly beyond the obvious level, then returned? What if it failed to continue? What if the candles began showing that the sellers were losing control? You may not know exactly why the reversal happened. You simply need to see evidence that your idea is becoming more reasonable. Waiting is not weakness. Waiting is information gathering. The 15th rule is do not confuse confidence with certainty. Confidence says, I have a plan and I am willing to follow it. Certainty says, I know what the market will do. The first is healthy. The second is dangerous. No matter how experienced you become, you cannot remove uncertainty from trading. You can improve your understanding. You can improve your timing. You can improve your risk management, but you cannot control what happens after you enter. That is why the mature trader becomes comfortable saying, I could be wrong. Those 4 words can completely change your trading because once you accept that you could be wrong, you stop needing the market to prove you right. You start managing risk instead. The 16th rule is do not change your strategy because of a few losses. This is where many traders destroy months of learning. They test a strategy. They take 10 trades, 4 lose, they panic. They search for another strategy. Then they discover another approach. They take 10 trades, 3 lose. They abandon that too. Eventually, they have collected 20 strategies but mastered none. A farmer does not plant a seed today, dig it up tomorrow, and plant another seed because nothing grew overnight. Skill takes repetition. You need enough trades to understand whether your process actually works. Of course, if something is fundamentally broken, it should be changed. But changing everything every time you experience discomfort is not improvement. Sometimes the problem is not the strategy. It is the trader's inability to stay with a reasonable process long enough to learn from it. The 17th rule is judge yourself by your decisions, not by today's profit. This may be the rule that changes everything. Imagine you followed your plan perfectly. You waited, you entered at the right place. You used the correct risk. You respected your stop. The trade lost. Was the day a failure? No. Now imagine another trader ignored their plan. They entered impulsively. They used too much risk. They moved their stop, then price suddenly reversed in their favor. They made money. Was that a good trading day? No, it was a lucky outcome from poor behavior. If you reward yourself for bad decisions simply because they made money, you train yourself to repeat those decisions. And eventually the market will charge you for that lesson. Measure your process. Did you follow the plan? Did you control your risk? Did you wait for your conditions? Did you manage the trade as planned? That is what you can control. The outcome is not fully yours. The 18th rule is stop watching other traders while you are trying to build yourself. This is especially difficult today. You open social media, someone posts a winning trade. Another person shows a massive account. Another trader says they made thousands before breakfast. You look at your account. Suddenly your progress feels slow. You start thinking you should be trading more, risking more, taking bigger opportunities. But you are comparing your behind the scenes with someone else's highlight reel. You do not know their losses. You do not know their risk. You do not know whether the screenshot represents one lucky day. And you certainly do not know what happens after the camera turns off. Your journey is not late. It is your journey. The trader you need to compete with is the version of you that keeps repeating the same mistakes. Beat that person, not somebody on the internet. The 19th rule is know when not to trade. This sounds simple. It is not, because sometimes the hardest decision is doing nothing while the market is moving. You see candles, you see opportunities, you see movement, but something is not right. The market is messy. The level is unclear. The risk is too large. Your mind is distracted. You are angry from an earlier trade. You are tired. You are trying to force something. That is when a professional mindset says, no trade. There is no shame in that. A surgeon does not operate simply because there is an operating room available. A pilot does not take off simply because the airplane is ready. Conditions matter. Your job is not to trade because the market is open. Your job is to trade when your conditions are present. The 20th rule is keep your trading simple enough that you can actually follow it. There is a point where more information stops helping. You add another indicator, another time frame, another pattern, another confirmation, another strategy, another opinion. Soon, your chart looks like a control room, and somehow you are more confused than when you started. More information does not automatically create better decisions. Sometimes it creates hesitation. You want clarity. You do not need to know everything happening in the market. You need to know what matters to your particular decision. Where is price? What area is important? What behavior are you waiting for? Where are you wrong? How much are you risking? Where would you take the trade-off? That may be enough. Trading is not an exam where you receive extra points for knowing more vocabulary. It is a decision-making environment. Clarity matters. The 21st rule is protect your mind as seriously as you protect your account because the two are connected. If you are exhausted, angry, distracted, desperate, or emotionally overwhelmed, your trading decisions change. You may not notice it immediately. You may think you are being objective, but your patience becomes shorter. Your standards become lower. You start taking trades you normally would ignore. This is why stepping away from the chart can sometimes be more valuable than staring at it for another 3 hours. You are not quitting. You are preserving your ability to make good decisions. Remember this, you cannot force clarity. Sometimes you have to leave the screen before you can see clearly again. And the 20-second rule is the one that ties everything together. Your goal is not to win every trade. Your goal is to become difficult to destroy. Think about that. Not difficult to lose, difficult to destroy. There is a difference. A trader who needs to win every trade is fragile. One loss can change their behavior. A trader who accepts losses can continue. A trader who risks too much is fragile. One bad trade can create panic. A trader who controls risk can survive. A trader who needs constant action is fragile. A trader who can wait has options. A trader who needs to be right is fragile. A trader who can say, I was wrong, can adapt. This is what professional thinking really starts to look like. Not perfection, resilience. You begin to understand that trading is a long conversation with uncertainty. You are never going to know everything. You are never going to catch every move. You are never going to avoid every losing trade. You are never going to remove fear completely, and that is okay. The goal is not to become emotionless. You are human. You will feel fear when money is at risk. You will feel excitement when a trade moves in your favor. You will feel frustration after a loss. You will feel the temptation to chase. The difference is that eventually you stop allowing every emotion to become an instruction. You can feel fear and still follow the plan. You can feel greed and still close the platform. You can feel FOMO and still let the market go. You can feel frustrated and still refuse revenge. That is discipline, not the absence of emotion, the ability to act correctly while emotion is present. And perhaps that is why trading teaches people so much about themselves, because the chart is always exposing something. If you chase, it shows you your impatience. If you move your stop, it shows you your difficulty accepting uncertainty. If you overtrade, it shows you your discomfort with doing nothing. If you increase your size after a loss, it shows you your need to recover quickly. If you take profits too early, it shows you your fear of losing what you have. If you constantly change strategies, it shows you your lack of trust in your own process. The market becomes a mirror, and sometimes you do not like what you see, but that is where growth begins. Imagine you have been watching a currency pair for hours. You have marked a level. You know what you want to see. Price finally approaches. Your heart beats faster. You feel the familiar temptation. Enter now. Enter before it leaves. You hesitate. Then you remember your rule. You wait for evidence. Price moves slightly beyond the level. For a moment, it looks like the market is going against your idea. Then it returns. The behavior changes. You enter. You define your risk. You accept that the trade can lose. You do not stare at every candle. You do not move the stop. You do not add money because you feel confident. You simply manage the decision you already made. Maybe the trade wins. Maybe it loses. That part is almost secondary because something important has already happened. You behave differently, and that is how a trader changes. Not in one giant breakthrough, but in small moments. The moment you decide not to chase, the moment you accept a loss, the moment you close the platform instead of taking one more trade, the moment you leave your stop where it belongs, the moment you refuse to increase your risk, the moment you see another trader making money and decide not to compare yourself, the moment you realize that missing a trade is not losing money, the moment you understand that doing nothing can be a professional decision, those moments compound too. Just like money compounds, just like skill compounds, just like mistakes compound. Every decision teaches your brain what kind of trader you are becoming. So be careful what you repeatedly practice. If you practice chasing, you become better at chasing. If you practice revenge, revenge becomes familiar. If you practice patience, patience becomes easier. If you practice respecting risk, risk management becomes natural. Your habits eventually become your trading personality. And your trading personality eventually determines what happens when the market becomes difficult. The strongest trader is not necessarily the person who can predict the market best. Sometimes it is simply the person who can remain calm when everyone else feels the need to act. Think about how strange that is. The market can rise without you. It can fall without you. It can reach your level and leave without giving you an entry. It can trigger your stop in reverse. It can move exactly as you expected after you close the trade. And none of those things have to destroy you because you are no longer asking the market to validate you. You are no longer trying to prove that you are smart. You are no longer trying to recover every loss immediately. You are no longer demanding certainty from something that cannot give you certainty. You are simply executing a process. That is freedom, not the freedom to make unlimited money, the freedom to stop being controlled by every movement on the chart. And perhaps that is the real meaning behind all these rules. They are not 22 tricks for beating the market. They are 22 reminders that the market is bigger than your emotions. You cannot control where price goes. You cannot control whether your next trade wins. You cannot control whether the perfect setup appears today. You cannot control whether another trader makes more money than you, but you can control your risk. You can control whether you chase. You can control whether you move your stop. You can control whether you take revenge. You can control whether you wait. You can control whether you trade when you are mentally ready. And most importantly, you can control what meaning you give to a loss. A loss does not mean you are a failure. A win does not mean you are a genius. A missed trade does not mean you are behind. A losing streak does not automatically mean your strategy is broken. A winning streak does not mean you have mastered the market. They are all pieces of information. Your job is to keep learning without allowing any single piece of information to control your identity. Because eventually, the trader who survives long enough begins to see the market differently. A candle is no longer an invitation to act. A sudden move is no longer something to chase. A loss is no longer an emergency. A winning trade is no longer proof of superiority. A missed opportunity is no longer a personal insult. The chart becomes quieter, not because the market became quieter, because you did. And when you become quieter, you begin to see things you could not see when you were desperate to trade. You notice where price is attracting attention. You notice where traders are likely to be trapped. You notice when a move has already traveled too far for the risk to make sense. You notice when the market is giving you information and when it is simply making noise. You stop trying to catch everything. You start waiting for what fits. And that is a completely different way to trade. The beginner asks, where is the next trade? The developing trader asks, is this a good trade? The experienced trader eventually asks, do I even need to trade this? That final question is powerful because sometimes the best decision you can make is not an entry. It is patience. Not because you are afraid, because you understand that your capital is limited, your attention is limited, and your opportunities do not need to be forced. You only need a small number of good decisions repeated over a very long period of time. That is why trading can be so deceptive. It looks like a game of predicting candles. But underneath the chart, it is a game of managing yourself. The market gives you uncertainty. You give yourself rules. The market gives you temptation. You give yourself patience. The market gives you losses. You give yourself acceptance. The market gives you opportunity. You give yourself discipline. And slowly, something changes. You stop asking, how much can I make today? You begin asking, how well can I execute today? That question sounds smaller, but it is actually much bigger because you can control execution. You cannot control profit. You can control risk. You cannot control the next candle. You can control whether you chase it. You can control your behavior. You cannot control the market. And once you truly understand that, trading stops being a battle between you and price. It becomes a practice in patience, a practice in probability, a practice in acceptance, a practice in self-control. And perhaps the greatest lesson is this: you do not become a better trader when you finally discover a strategy that never loses. You become a better trader when losing no longer makes you abandon yourself, when winning no longer makes you reckless, when missing a move no longer makes you chase, when uncertainty no longer makes you panic, when patience no longer feels like wasted time, when a good decision matters more to you than a good outcome. That is when trading begins to change. Because the goal was never to predict every move. The goal was to become the kind of trader who can face any move without losing control of himself. And when you reach that point, the chart may not become easier. You simply become harder to shake.